Earnings are the biggest driver of cementing fundamentals on our investments. And if we look at the earnings so far, the earnings season is telling us something quite different in the Eurozone than in the United States. If we look at the Eurozone, the earnings season is showing a very, not very exciting earnings because, for example, if we look at earnings surprise, positive surprise about 50%, negative surprise about 50% as well. Aggregate surprise so far minus 4.9%. Therefore, it shows why we continue to hear the mantra of Europe is cheaper. It tends to be cheaper for a reason. Unless we see a real U-turn, a real improvement in earnings, it's going to be very, very difficult to see Europe outperforming when at the same time the growth of the Eurozone and emerging markets continues to be subdued and the macro drivers are not helping. Now look at, on the other side, the S&P 500. The S&P 500 posting better results than expected. Obviously, like Europe, from a very low base, from earnings that were downgraded first, but still 77% beat, and aggregate earnings surprise is also positive. Therefore, it shows why there is this gap in valuation between both indices, and the macroeconomic data in the United States is much better than in the Eurozone and in the global economy. As such, it is still an environment to continue to be more invested in the United States than in other countries, despite the rise of liquidity that is helping all risky assets.